there are four key issues driving the markets right now. First of all, we need some resolution on whether this recent soft economic data that we've been seeing in the US is the precursor of something more sinister in terms of recession. Secondly, resolution to the sovereign debt crisis in Southern Europe and Greece. I think thirdly, the issue of whether China is set for a hard landing or a soft economic landing. And lastly, sort of debate around the US housing market, whether it's set to go into a double dip after initially stabilizing. I would say those are the four key issues.
Yeah. Let's begin then perhaps by talking about the soft patch. And what's your reading? Are you seeing? What's your call?
Yeah. Well, we think that the market consensus is in fact that this is just a soft patch in a longer term uptrend, and that it's not the start of a much more prolonged slowdown or recession. And we think that actually for once the consensus is going to be correct, and that as we see data unfold over the next quarter or two, we'll see in fact the data improving, which will ease the market's fears.
How big a risk is there that this is not a soft patch, but is in fact perhaps the beginnings of a double dip?
Yeah, that's a good question. Well, there's always that risk, but if we look at some indicators which would give us a sort of an early warning, an early lead to whether this is the start of something more sinister slowdown, there are a couple of reasons why we just don't think that's the case. First of all, real interest rates are just too low. Secondly, the sort of yield curve is too steep. Thirdly, bank lending conditions are too loose. Normally you need a sort of credit crunch. You need the banks to sort of stop lending for there to be a genuine recession. And if you look at the sort of credit lending standards in the banks, they're actually relatively easy. So for all those reasons, we think it's highly unlikely that in fact this is the start of a genuine recession. What this may well be is the market's just, or the economy is just transitioning from a certain level of growth to a lower level of growth. But we're talking about low growth, not no growth.
Okay, so let's talk about the next big one, which is Greece. Now, Greece has been in the news for a variety of reasons, including the fact that there appears to be no clarity on whether actually, even if it is rescued, it would have defaulted.
That's right.
What's your call?
Look, I think what the Europeans have done is, in terms of delaying the Greek default, is actually a good thing. I would wholeheartedly support that. The markets are still too fragile to withstand what we call a disorderly default. And the contagion, the knock-on effects that come with that. So I would fully support this proverbial kicking the can down the road. That Greece is going to default, everybody knows. It's just timing when the markets can handle it. And Spain needs time to distance itself from the other European countries in budgetary problems. And then the banks need time to raise capital, to build their capital buffers up. To withstand the defaults and the write-downs that are going to come.
Would it not be better to take the medicine now, if you like, allow Greece to default and then deal with the consequences?
Look, I don't think so. As I say, I think markets are just too fragile for that to happen. I think the consequences would be huge if Greece defaulted now. I think there would be a genuine a run on the banks, in many banks in Europe. Already you're seeing a slight liquidity run on the banks in Greece. Many Greek citizens have taken their money out of their banks because they don't trust their own banks and are putting the money literally under the mattress. And the European Central Bank is providing the cash, the liquidity to the Greek banks to pay them all out. Now that could only get worse if we defaulted right now. And I think personally, I think it makes sense to in fact delay the issue to when markets and banks and economies are on a more sounder footing than they are right now.
Yeah, at the beginning of the crisis, because people spoke about the peaks, and we have now seen we're in the second stage, if you like, of from where we started. Is there a danger there? Are we in a situation where we'll see another country come into the picture after Greece? Who's the next big one?
Well, I think if Greece were to default in a disorderly fashion, I think the markets would turn on Portugal and Ireland pretty quickly. Recently you saw the credit spreads of those two countries rising in anxiety up until a week or so ago when there was an initial agreement put forward. as the austerity package passed through the Greek Parliament.
Right. So preventing a Greek default is essentially also trying to prevent Iran similar problems down the line in the other countries.
Yes, that's right. That's right.
China, the engine of economic growth in the world in the last couple of years or so. How big a danger is there that this is a real slowdown that could knock the wind out of global growth?
Yeah. Well, there's certainly, I mean, the Chinese monetary and fiscal authorities have indeed been trying to slow down their economy, which they've thought is perhaps running too hot in certain sectors of the economy. Now, the market's anxiety has gone from, is China too hot, or is it now about to be too cold? You know, is the growth going to go too slow? I think that I personally don't think that's a massive risk of Chinese sort of too slow growth, because the Chinese authorities have many, if I could say, bullets at their disposal. They can reverse all the interest rate hikes they've done and reserve requirement things. So they have scope to actually come in and unwind some of the tightening.